This presentation provides an update on Europe. In a nutshell, we will begin by contrasting the rising mood in financial markets with lagging real economies and troubling levels of unemployment. We then explore the role of balance sheet stresses, household, corporate, bank, and sovereign, as a source of weakness in demand, and of spillovers to emerging markets in the East. Finally, we conclude with the message that the respite in financial markets should be used to press on with reforms that let balance sheets adjust in as orderly and growth-friendly a way as possible. Perceptions about euro breakup have receded, reflecting policy efforts both euro-wide, for example OMT, ESM, and banking union, and at the national level, fiscal adjustment and other reforms. As a result, CDS spreads have declined across the board. Corporate bond spreads have also declined in the periphery, and issuance has rebounded from lows in the first half of 2012. But bank lending rates, as opposed to corporate bond rates, remain stubbornly high in many places, as shown in this chart. The incomplete pass-through of policy rates is important because European firms and households rely much more on banks for financing than their US counterparts. Let's now turn to the issue of growth in Europe. There are signs of improvement in high-frequency indicators, but so far they still amount to stabilization of the rate of decline. As shown here, both of these manufacturing indicators are signaling continued contraction. The overall picture remains one of lagging economic activity. GDP levels in most countries remain below those in 2008, on the eve of the crisis. Unemployment is painfully high, especially in countries under market stress. The growth and job situation looks quite fragile as Europe turns down again. This is not your usual recession. Why has demand in Europe taken such a big hit? Looking at demand components, it is clear that investment is in a double dip. And as you see in this next slide, no country is back to its 2007 level of investment, not even Germany. A similar story applies to consumption, the largest component of aggregate demand. And again, it is countries under market pressure that have the weakest indicators. Let's now turn to the notion that balance sheet stresses are behind the economic downdraft in the countries under market pressure, and therefore that the associated weakness in demand may linger. This is the key slide in this presentation. It shows that the countries with the greatest pre-crisis balance sheet stresses are the ones with the worst post-crisis growth outcomes. For each country, balance sheet stress is simply the stock of debt at end 2007, plus its increase in the previous 5 years. The result is then rank-ordered on the x-axis of the chart shown here. Note that countries that have been under market pressure are to the right, Portugal, Spain, and Ireland, and countries with no or low market pressure are to the left, Germany and France. Whatever your views about definitions and causality, the role of balance sheet stress in Europe's downturn is stark and evocative and should force us to think more deeply. The relationship also holds at a more disaggregated level between household balance sheet stress and household consumption. Note that 4 of the 5 countries to the right have had housing busts. And the relationship is even more apparent for corporate balance sheet stress and investment. Let's try to categorize countries by their relative problems with household, corporate, or sovereign debt. Here, we slot countries into categories, simply ranking them by each type of debt, and then picking the top third of the distribution. We could equally have used thresholds from econometric work. Either way, we pick up the countries that have been under market pressure. Let's focus on one at the center, Spain, and draw the macro implications of balance sheet stress. Net private savings have risen and will remain high because households must save more and corporations invest less in order to repair their respective balance sheets. Net government savings fell sharply with the crisis and are now projected to rise as the sovereign seeks to reverse the jump in its indebtedness. Together, this means the current account has to rise to a surplus. Here's the key point. A surplus can be generated either via recession, through compressed imports, or more exports, through gains in competitiveness. Clearly, policies must be set to deliver competitiveness and exports. By contrast, the issue in Italy is not household debt, but corporate leverage, as measured by the debt-to-equity ratio, which has risen in the last decade. Again, firms can carry more debt if interest rates are low, but that is not the case for the countries on the right. Weakness in the financial sector is forcing needed, but too rapid deleveraging by corporations. The bulk of those squeezed out in Italy are small and medium enterprises. What has been the impact of the resulting weakness in the periphery? It's hard to believe the core of Europe can carry on unscathed. As shown here, German investment is being hit by declining euro area exports. The correlation between the export and investment lines is stark. Some argue that the fall in German investment is too large to be explained just by euro area exports, suggesting a broader weakening of animal spirits from euro area woes. Trade is a key channel for transmission of the euro area shock to emerging Europe. The high export numbers you see here are shares of GDP, so any slowdown in exports to the euro area will hit overall growth hard. And in fact, we do see exports in many emerging markets slowing, including those that are part of the supply chain to stronger performers such as Germany. Emerging European countries also face a downdraft via the banking channel. The jump in parent bank funding costs, represented here by CDS spreads, has reduced funding to subsidiaries in the East, resulting in flat credit across the region. What about bank balance sheets? We have not talked about banks yet, because they have already had extensive treatment, both as an amplifier of balance sheet problems and as an originator of shocks in their own right. But we do want to highlight one important point on bank balance sheets with this slide. In 2007, it didn't make much difference to bank funding costs, and thus to bank lending rates, whether bank balance sheets were highly dependent on wholesale funding, measured here by the loan-to-deposit ratio. The regression line is pretty flat. Now fast forward to 2012, and you see a much steeper line. Countries with higher loan-to-deposit ratios face higher funding costs, which they pass on to lending rates. Thus, bank balance sheet structures are thwarting the transmission of ECB policy rates. Banking union reforms are a way to flatten this line, which we've described in a recently released staff discussion note. This brings us to policy advice more generally. The recent progress on the policy front has been huge: OMT, ESM, banking union, and national level adjustment. At the same time, we have stressed the need for continued progress in three broad areas as a means of facilitating orderly balance sheet adjustment. Take national policies. Fiscal adjustment is needed in light of the run-up in sovereign debt. But as deflationary forces from household and corporate balance sheet adjustment are strong, we advise adherence to structural measures, not to nominal deficit targets. Otherwise, you risk a deeper recession and frustrated balance sheet adjustment. Similarly, structural reforms are key to getting balance sheet adjustment with minimal negative growth impact. Recall the figure for Spain, where it was argued that the implied current account adjustment could come from recession or from reforms to raise competitiveness and exports. Clearly, we want the latter. We will also need to look more carefully, in upcoming Article 4s, at legal and procedural means of resolving distressed assets, and of developing capital markets to reduce bank dependency. Given the balance sheet impediments to lending, it may be worth considering ways to support SME financing, as Italy has done. Our monetary policy advice also can be seen as facilitating balance sheet adjustment. There is still some scope, albeit limited, for conventional policy to reduce interest rates, and even more for unconventional policy, such as OMT, to bring down rates and ease the burden of repayment further, not just for the sovereign, but also for the private sector. The completion of EMU architecture would play a similar role. For example, steps to reduce banking fragmentation listed here would attenuate pressure for too rapid deleveraging in the periphery and allow lower interest rates to be passed on to corporates and households. And greater fiscal integration could help prevent country-specific shocks from becoming systemic ones through a stronger ex-ante framework for fiscal discipline and some form of fiscal risk-sharing. To sum up, important progress has been made, but it is also progress that needs to be built on. The recovery is fragile, balance sheet problems are a major drag on growth, and monetary transmission to the periphery is impaired. Hence, orderly balance sheet repair at the national level and supportive monetary policy and EMU architecture at the union level are crucial to help translate the financial market recovery into a real economic rebound.